It's time for Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to Your Personal Bank Show, and today I'm going to be sharing some information that, frankly, I haven't hardly seen anywhere, and I think this is going to be of extreme interest to a lot of folks. As a lot of you know, and you've heard on, you hear on the promos and things like that, I'm the chairman of the board of a bank in formation. What that means is we're in the process of starting an FDIC-insured bank. Yes, we plan to open the doors and have a physical location and all that kind of stuff. And if you've listened to the shows previously, we actually were we were ready to submit our application to FDIC for the bank charter end of March of this year. And of course, when COVID hit, everything got put on hold and has, basically been in a holding pattern since that point. Now, obviously, we're looking at we're going to be opening a bank at some point. Don't know when. Maybe early next year, early 21. We're going to see. But we're watching the economic situation very closely. FDIC, the banking industry, what's going on, and I'm routinely having meetings, each month. As far as looking at this, when is the right time to look at starting a bank, opening a business, if you will. And I had some very eye-opening information statements that were shared with me just a few days ago. And I want to share with you because, like I said, I do keep a close attention to, the messages that are going out there, the information, the articles that are written, things like that in the financial world, obviously with a financial focus. The economy, all those kinds of things, because, that's of great interest to me because as, someone in the financial industry dealing with clients and, of course, in the process of looking at starting a bank, those things are of paramount importance. Like I said, this is information you're going to find, I think a lot of people are going to find very interesting. And it's, like I said, I'm seeing it in a few places. I've seen it here and there. But here's what it is. Here's the situation as, like I said, what I was talking about. Again, we were looking at economic factors, things like that. When does it look like it'd be a good time to submit an application and start a bank? And I was talking to some very experienced bankers, former bankers, some folks have been presidents of banks, things like that. And the consensus was really quite straightforward, is that now is not the time to try to start something like that because, well, of course we have an election upcoming soon and things like that, but it's not even worth looking at until after the first of the year. There's still coronavirus uncertainties. There's still shutdowns in parts of the country that hasn't opened up yet. So those kinds of things obviously impact our money, impact our the economy and all that good stuff. But I'll tell you what, the biggest thing that the folks from the banking side shared that I thought was kind of eye-opening a little bit. There's a lot of discussion. There's been a lot of discussion for months now. Are we going to have a V-shaped recovery, a U-shaped recovery, an L-shape, a swoop, whatever? I believe there's going to be a recovery at some point. Don't get me wrong. I think most people agree with that. It's just a question of when and how long and that kind of stuff. And those were some of the discussions that I had with some of the bankers. Now, understand, bankers, as a general rule, are risk adverse. Okay, but they do study money and look at money probably closer, certainly from a risk standpoint, closer than any other industry out there. I don't think there's any argument with that. So from a risk-adverse standpoint, and just looking at, risk-reward type of stuff, the comments I got from several folks wasn't if there's a recession coming, but when the recession comes. And the reason they were making these kinds of statements. Now, like I said, I hope they're wrong. I mean, no one knows for sure what's going to happen, obviously. But a couple of statements that were made really lent some credibility to what they were saying. And it was this. A lot of folks, we know that there's been, moratoriums and things like that on foreclosures and on evictions and things like that, really both on the residential and commercial side in many places in the country. And what was being shared with me, some of the information, I can't give you all the details, but here's what I want you to understand is what was being shared with me was there's a lot of money There's a lot of loans, past due loans that banks are carrying right now. And basically the regulators are allowing them to carry those. And really, in essence, it's not being reported, if you will. So they're carrying these loans, they're allowing to defer these loans, okay, until it looks like probably at this point, through the end of the year. And until these deferrals, expire or whatever, right? Well, what's going to happen when all these deferred payments on all these mortgages and loans and various things, aren't being deferred anymore? In other words, there's going to be a large backlog of money owed to banks, and that's why the banks have tightened up lending standards. That's pretty much a well-known fact. They're maximizing their cash. The banking industry in general is definitely in a better position financially than they were going into the 08-09 Great Recession, that we called it. So the banks in themselves should be in much better position to weather the storm this time. But the fact is, what they're stating to me is there's going to be a storm. There's going to be a big one because of all these past due payments becoming due. And how do you make up on those past due payments and those kinds of things? So there was a lot of validity, I should say, and a lot of concern. And I talked to some very big money investors, particularly in the real estate investing world, who echoed the same sentiment. There's a lot of fear in that arena and concern. And like I said, starting a new entity right now or something like that and trying to raise funds for that, probably not a good idea. It's really a hard road to slog, if you will. It's going to be a challenge because, like one person said, it's going to be hard to overcome fear. And there's a lot of it right now because what is going to happen, again, when these past due payments now become due? How the repayment plan is going to work. It's extra money. It's going to have to go back and all that kind of stuff. That'll cut into profits of an individual or a company, right? So this is not being reported very much. There's not much being said about it. It's kind of like I said, they're kicking the can down the road. The only area that I've been able to find some articles on this at all or any information about this really is coming from the Federal Reserve. And, some of it's public record and whatnot. So the thing is, this information that I'm sharing is not popular, okay? And I want to go back to, started sharing some of this stuff back in early March, and I got a lot of blowback initially about saying to people, hey, this coronavirus could potentially have some serious impact on your money and what's going to happen with the economy and such. Sadly, the information I was sharing, again, a lot of it was coming from Federal Reserve sources, things like that, turned out to be true and even beyond what I expected, to be fair. But initially, I got a lot of blowback. The market's been good for a decade, all this kind of stuff. The economy's great. Unemployment was all-time records. You're just, you're being Chicken Little. The sky's falling. No, there was valid reasons and concerns. In fact, now you can go back and if you look, and Chairman Powell, Federal Reserve, started talking about coronavirus and economic impact in mid-February. So they were some of the first people that really came out and said, hey, there's a concern here that we need to have. So there's a little bit about it. There's some articles about it. If you can research some things about the Federal Reserve recently that have come out, okay, that talk about this type of thing a little bit. But like I said, it seems to be getting swept under the rug over the overwhelming, the markets have recovered, things are going great, people are feeling good again, and coronavirus seems to be on the subsiding. But what's going to happen after that? So we're going to talk about that more in the next segment, so make sure you stay tuned and don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back. I'll tell you what, I've been talking about a few things here that I find a little difficult to talk about because here's why. In general, I'm a pretty optimistic, upbeat kind of guy. I'm positive about the future, our economy, our country, all those kinds of things. And when I put out a word of caution, I'll put it that way. Maybe that's the way to put it. I'm not trying to scare people or anything like that, but whenever I put out a word of caution, I find it a little difficult because it kind of goes against the grain of my personality, of course. And generally most people are pretty optimistic and upbeat that are investors. Don't get me wrong. But like I said, in early March of this year, I started putting a message out, hey, this coronavirus thing could potentially be a real big issue in terms of our money, our economy, the markets, and all that kind of stuff, which turned out to be very true. There was a recovery in the markets, of course, but I've talked about this in the some previous shows. And by the way, you can go to yourpersonalbank.com, listen to any of the previous recorded shows. And I did talk about, and there's articles on this talking about, well, most of the recovery hasn't been broad-based by any stretch of the imagination. It's been very narrowed, and even at one point it was down to one stock, Apple, basically driving, the Dow, for example, to new record highs, basically. So if you're in those specific areas, that's primarily tech area, you've seen a strong recovery, but broad-based not necessarily so. And so the thing is, and then the other part of it is part of the recovery, was we had an unprecedented situation where, our government basically wrote checks to a large number of people, hundreds of millions, $1 trillion of stimulus, right? And, that impacted the markets and things, obviously, and the economy. We got a boost, which was what it was supposed to do. The Federal Reserve has been adamant about saying we need another one. It's been consistent with that because they're saying the economy is going to, it's coming back in some arenas and it's struggling in others. You know what I mean? So, but the biggest thing is the information I was sharing in the first segment here. And I don't mean to be I'm not trying to sound hesitant or anything. I'm just concerned. And I think this is something that should be of concern for anyone who's an investor. Anyone who's, putting money away for the future. What you want to think about is risk and potential risk. Obviously, there's risk reward with anything. But the biggest thing in the news I shared in the first segment, if you missed it, again, go to yourpersonalbank.com to listen to the whole thing. But to paraphrase, there's a big concern in the banking industry. As you know, I'm dealing with in the process of working on starting a bank. About the past due, there's been a lot of loans that have been deferred because of the pandemic. And when those monies come due, then what? How's that going to impact real estate values? How's that going to impact the economy, the markets, all those kinds of things? And a lot of the folks that I'm talking to that are experts in their fields, these are bankers with decades of experience, literally. Some leading banks and all that kind of stuff. And the comments that they're stating are not like if, but instead are when the recession comes. In other words, their attitude is the recession hasn't hit us yet. I mean, technically, we kind of went into one because of the shutdowns. We've recovered from that a good portion. We dropped quickly, we recovered quickly, a good portion of it, not all of it by any means. But their statements are like, well, the recession really hasn't started. And when it starts, when it comes, and they're thinking sometime next year, who knows. But whenever these deferrals of these payments, and apparently there's a lot of money that banks are holding loans that are not getting paid. And it's not really getting reported. The regulators, the bank regulators are allowing this to be deferred based on, all the stimulus efforts that are happening. Okay, it's public knowledge. This isn't no secret. Foreclosures aren't happening, and evictions are basically not happening in many parts of the country. So what's going to happen when all this kind of comes together, or when that ends? And that's of real concern. Let's be real. I mean, that's a fact. And why is this so important? Well, again, one of the main things I talk about all the time is having a portion of your portfolio protected from risk. And this is nothing new. This is something I've been sharing for over 20 years. And whether it's good times or bad times or anything in between, having a portion of your portfolio, having a portion of your money not subject to risk is extremely important. Modern portfolio theory, I refer to it all the time, which has been around since the 50s, widely accepted, widely known, talks about a 60-40 split as a rule of thumb for anyone's portfolio. Now, that can adjust depending on somebody's risk tolerance, their age, their financial age, I should put it, how many years they have left to put money away, that kind of thing. But 60-40 is kind of the rule of thumb, and that 40% should be in something that's safer, consistent, income producing. That's really the purpose behind that 40% bucket. And by the way, modern portfolio theory talks about once you get in within 5 or 10 years of retirement, that should probably be closer to 50-50. Now, again, percent-wise. Now, again, that safer bucket, that consistent income-producing bucket, the problem is we're having these days is with the low interest rate environment, which is like one of the articles I read from the Federal Reserve, they're really now starting to finally recognize or admit that they kept the low interest rate environment around far too long after the Great Recession. It's almost kind of like they were shell-shocked, if you know what I'm saying. So the reality is this: by keeping extremely low, historical low interest rate environment going on for not 12 years now, it allowed companies and people to take on far more risk because of cheap money, borrow, easy, low interest rates, right? It also propped asset values. And one of this article here in particular that I just read, it's a CNBC article, by the way. It's how low interest rates made the current economic crisis worse. Okay, and this is from one of the Federal Reserve directors. Okay, they're interviewing. Basically, it's saying, look, it's going to the encouraged risk taking are making the current economic downturn worse. And he pointed out specifically stating how low rates persisted for an extended period, even after the economy had made progress. They're finally admitting, well, we kind of overdid it. And so asset prices went up, and particularly think about things like real estate and various things like that and other assets, let's face it. Because of the low cost. I mean, bottom line, it's very simple. If it's cheaper to borrow money, say, to purchase a house, to put it into simple terms, you can afford more house, or a higher priced house, I should say. Now, what that'll do is, of course, push the prices overall, the asset values, prices of those houses up. That's why we've seen tremendous growth in the real estate values over the last decade. Okay. Again, the thing I shared in the first segment, one of the things the bankers are really concerned about right now is these deferrals of these payments because of the mortgage, not the ability not to foreclose and things like that. The deferrals that have occurred, and there's been apparently a tremendous amount. What happens when that all comes due? And we have an inflated asset prices values because of the extremely low interest rate environment. What's going to happen? My point is simple. I've said this all the time. Again, I'm not saying this to be fair, to be a Chicken Little, the sky's falling, or anything like that. What I'm saying this is it's about having a healthy concern, risk avoidance, having some risk, and this deals with your risk tolerance. Again, going back to that 60-40 split, this is where that safer bucket becomes key. And again, your personal bank, I've shared this so many times over the show, if you listen to it, is a great fit for that bucket. It doesn't have to be bonds like most people think about. It just has to be an asset that has consistency, some safety, guarantees are nice, okay, and have income producing, grow irregardless of what the economy and the markets and those kinds of things are doing. And that's what the personal bank does. Stay tuned in the next segment because we're going to talk about that further and how exactly that works.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
So we've been talking about some information, some concerns I've received recently from the banking industry, talking about the deferrals and what happens, particularly the mortgage and commercial and residential lending, the deferrals that have happened. Apparently that's building up on the books of many banks. What happens when those moratoriums end and, well, those loans become due? So some of the statements, like I said, if you heard in the first segments, the banking folks that I've been talking to in terms of, us looking at our bank in terms of when to start and some that type of thing, their statements are more not about if there's a recession, but when. I hope they're wrong. I really do. I hope we get through this. We have a nice V-shaped recovery and everything works out great and we're surprised. I mean, certainly I would say April, most people were surprised after most people got kind of shocked with the March drawdown. The markets, we had about 30% drop in the S&P in 30 days, right? And then a month or two later, it basically came back. That was surprising on both sides. So predicting what's going to happen is is an exercise in folly. I understand. But when you have major concerns like this, I think it's at least healthy and wise to at least keep it in consideration. And again, looking at making sure that safer part of your portfolio, that mixed bucket, I talk about the 60-40 Modern Portfolio talks about theory, talks about that 40% safer income producing, making sure that's going to do what it needs to do. This lower interest rate environment, historically low interest rate environments, the Fed has put us through now through the last 12 years, and they're stating they're going to keep it there for the next 2 or 3, it looks like at least, has caused a real depression in terms of returns on things, interest returns on things like bonds and whatnot. So where do you go to get a decent rate and have some safety and consistency? Well, that's where your personal bank can step in and really accomplish that. And one of the things, it's so funny, when I first talked to somebody, a couple of things they're surprised by. One, they had no idea that most of them, that there are companies paying dividends, 6% still today, have been paying 6% dividends or better for the last 25 years plus, and never missed dividends since before the Civil War. That's a surprise, but it's a fact. Secondly, a lot of people are surprised because, again, we're using a life insurance tool and a banking tool to accomplish this positive arbitrage scenario, okay? But what they're surprised by is, we have folks that are in their 30s doing this. We have folks in their 70s doing it, and it works for both. I'll get a lot of folks, especially it seems like a lot of money radio listeners, I'll have someone reach, well, I'm in my 60s or whatever, and, this isn't going to work for me because I'm too old. They're surprised when I run the numbers and figure out it does work. In fact, it works surprisingly well. Just because somebody's in their 60s or whatever, 70s even, doesn't mean this can't work. Life expectancies have gone up. People live longer than we've ever thought we would, many of us. And so the numbers work, okay? So don't discount that. The other thing is the low interest rate environment has created an opportunity, obviously, with the positive arbitrage using the banking side, the bank tool. Again, what are we doing? We're setting up a high cash value policy that's designed to grow cash, pay dividends. Dividend rates currently 6% plus and have been for the last 25 years with several companies. And these are highly A-plus rated, billions of dollars of cash reserves companies, well positioned to continue to pay strong dividends going forward. Okay, they've been doing it for well over a century. Some of them since before the Civil War, even. My point is that we're not doing this. Think about what most people think about in life insurance. You got to throw out the window. Yes, there is a death benefit involved, but again, the main focus here is to maximize the cash growth, the dividends, right? And then when you want to access money, and this is where it gets real interesting, because a lot of people who reach out to me initially are looking at it as, well, it's a good diversification idea. Maybe, like you said, that safer bucket of money, if I can put in something here, has some guarantees, has a decent return, like I said, 6% dividends is not bad. Plus, if we structure it correctly, we can put in the tax-free aspect into it too. So, 6% tax-free is just not half bad, especially these days, with a long-term history of consistency and some guarantees. But then when they realize, wait a minute, we can set up the bank line of credit. Remember, the line of credit, the cash in the policy is the collateral for the line. And then you can access the money if and when you need it. And let's face it, we all spend money. We all need funds to live, right? You can pick up a positive arbitrage right now around 2-3%. Because, well, if you're getting credit at 6 and you access the funds through the bank line, it's costing you, let's say, between 3 and 4, what's happening? You're making 2-3% on your money still. And this is on money you've spent or used elsewhere. You see, once that starts to click, then people start realizing there's a whole lot of opportunities here. There's a whole lot of things that your personal bank, I can do with my money as a result of your personal bank. Because where else can you get return on money that you spent? That's the key. And that's one of the key differences. And so, again, when you invest money and you invest in an asset and you get a return, you get what you get, right? We all understand that. It's pretty straightforward. But we also spend money. We also spend money on things we both need and want, right? And we start calculating and looking at how many dollars that is, how many dollars are going out the door every day, every week, every month, every year, right? If you can start to capture, whether it's an individual, household, or a business, doesn't matter. If you can start capturing some interest on that flow, on those dollars going out the door that disappear forever normally, right? Normally when you spend money on the basic expenses of life, food, food, housing, clothing, those kinds of things, and other stuff too, do you ever see a return on that money in the future? No, of course not. You spent it, right? What if you could pick up a couple, 2-3% on that for the rest of your life? See, one of the things I've even heard too is people say, well, it's a couple percent. Yeah, 1 year, no, not a big deal. What about 5, 10 years, 20? How about the rest of your life? If you understand compound interest at all, you understand that ends up can be an awful lot of money. And like I said, I had another gentleman. He's a business owner, Mensa member, all this, very, very intelligent, very smart person. Pointed out, he says, look, if I can pick up 1% on money that I couldn't get else otherwise, that's worth it. That's just an extra 1%. I said, exactly. This is an extra 2-3% on money that you have no other way of picking up that return on, because normally, in a normal situation, you would have spent it, right? That's where the personal bank changes the game. It's a game changer. It changes the financial picture in a major way. Because, again, we all spend money. We all have expenses. Whether it's our home or our business, we have expenses, right? And, again, it's about picking up some of the return on that flow of that money that can make all the difference. Now, by the way, the more traditional, there's several things you can do here. Could you just put it in there and leave it alone and let it just grow and be passive with it and get 6% dividends tax-free? Sure. I mean, there's nothing wrong with that. And that works quite well, frankly, for an awful lot of folks. But those that want to be more proactive, I should say. So we have passive folks. We have more active investors. You want to take that money and, say, reinvest into something else to increase your returns. Sure. I mean, I say this all the time. If you've got an investment that you like, and I would say most people listening to me right now do, you're listening to Money Radio for a reason, right? Well, if you have investments and assets that you like, fine. I'm not going to tell you to stop doing those or doing something else. All I'm saying is add a step. One step to the process. Flow it through the policy, get the dividends, turn on, access it through the bank line of credit, pick up the difference, and go invest in your asset or your investments that you like. What does that do? Well, for one, it increases your rate of return. Whatever your rate of return was on the asset or investment you liked, you can add a couple percent to it. There's nothing wrong with that. If your rate of return is 10%, we add 20%. We add 2% to that. That's a 20% increase in rate ROI, rate of return, right? Return on investment. Am I right? Stay tuned in the next segment. We'll talk about this some more because, again, this is a game changer. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third. We're talking about some information, like I said, that I've been shared with me in terms of from the banking industry, real estate world. And this comes from a result of me being involved with actively in the process of opening a bank and looking at what's the best time to do that economically. And I shouldn't say what's the best time. When's a good time, right? And like I said, some of the information was shared. I've shared in the previous segments. And if you missed it, go back to yourpersonalbank.com and listen. You can listen to any of the previous recorded shows, by the way. But the thing is, these banking experts, people have decades of banking experience talking about, the amount of loans that have been deferred because of all the coronavirus, the pandemic, stimulus things that have occurred. When those become due, they're talking about not if, but when the next recession starts. I hope they're wrong. I really do. But what if they are right? The thing is, any reasonable human being has to recognize that risk is there and that potential risk is there. And that's why the modern portfolio theory talks about having that split, that 60-40 of equities, bonds, or, and the thing is, nowhere in there does it really say it has to be bonds. It just, that safer part of your portfolio really should have something where it's safer, has some guarantees, would be really beneficial, has some consistency on returns. You want some consistent, steady Eddie stuff going on, because if we do go into a recession like many in the banking industry feel we are going to, that's the parts that's going to shine. It's important to have. Folks that do all one or all the other, it's been proven long term doesn't work as well. It's that mix, right? It's that mix. It's that balance. And again, low interest rate environment, let's face it, returns on bonds and things like that are struggling because of the low interest rates. That's why, again, the personal bank is a strong contender in that area. It's worth considering and looking at as your diversification tool in that safer bucket of money. And if you're nearing retirement or needing to count on that money more, that percentage should be higher, certainly. That's pretty standard advice, okay? More than just 40%. The thing is, we have companies been paying 6% dividends the last 25 years. Never missed a dividend since before the Civil War. That is consistent, long-term, strong dividends. We can structure it so it's tax-free income. So if you now consider a 6% dividend tax-free, that becomes very, very competitive. And again, if you're someone who's looking to diversify or having some of or looking at that safer bucket because that part of your portfolio may become paramount down the road in the fairly near future, or you're looking to generate income to supplement retirement and all that, and not look at this as an option and consider this as a tool, frankly, you're doing yourself a disservice. I don't know how else to put it, okay? You should at least consider it and look at it, look at the numbers. And again, contact us at yourpersonalbank.com. We'll be happy to run that for you and show you what we're talking about. You'll see, and most people find when they do that, they're surprised at how competitive it is, how strong of a alternative it really is. And then when we add in the other aspect of the bank line of credit, because again, if this is designed for money that you're going to say supplement income, so you're going to take income from it, right? Well, instead of taking income and selling a certain amount of your position to supplement retirement income, and once you sell it and use that money, it's gone forever. What if you could pick up 2 or 3% interest on those dollars? In other words, that money you're using to supplement your retirement, what if you could pick up interest on it, on a portion of it? And that's what your personal bank does. Would you have more money? The answer is yes, you would. It's kind of mathematical, okay? There's really no argument there. I mean, you're getting interest on the money or you're not, right? So would you have more money? And the answer is absolutely. The thing is, that's what combining the insurance tool with the banking tool does. It creates that positive arbitrage for you, okay? And my most often probably question, also surprise, is many people think they're too old to do this. Well, we have people, like I said, successfully doing this from, I have teenagers doing this, okay, 20s, 30s, all the way up through 70s. Our oldest client successfully we've set up a personal bank on, and the numbers worked. She was 79. Okay. Now, granted, her health was relatively, she was average health, nothing tremendous, nothing bad. Okay. So if someone's, in the 70s, health is going to be a little bit more of a concern. Will they qualify? But if they have somewhat average health and they haven't had any major health issues in the last 5-10 years, probably going to be just fine. The numbers will work. And even if they don't, we have a plan B. We can insure a relative, a loved one, a business associate, whatever. You're the owner. You control the money. You get the dividends. You get the 6%, like I said, credited dividends currently, all that kind of stuff. And you can benefit from the positive arbitrage and all that. So it's still not the end of the game. In fact, I'm working on one this week with a client from one of the listeners who, age and health-wise, I told him straight up, this is about 50-50 if we're going to get you approved or not. But we're looking at insuring his wife or his kids. He'll still control the money. He'll be the owner. He'll still get all the benefits of the dividends, the consistency, the safety of the money, the tax-free income, and the positive arbitrage when he accesses those dollars to supplement his retirement. if you can pick up an extra 2 or 3% on the money you're using to supplement retirement or not, which choice are you going to make? It's kind of an obvious answer, isn't it? And that's why you want to really look into this. Now, again, just asking any financial advisor who you're probably in most cases, and I'm going to tell you, easily over 90% accuracy rate, you're not going to get accurate information because this is very much an area of specialty in the financial world. And I've talked about this in previous shows. Again, go to yourpersonalbank.com and you listen to any of the previous shows. You can look at some of them. I talk about in extensive depth why most financial advisors are just not very familiar with this, nor offer it or talk about it. Okay? There's many reasons behind it. But the reality is you're not dealing with an expert. You're not dealing with somebody that really, truly understands this tool and this concept. Therefore, your information is going to be, let's just say, limited at best, and sometimes just downright inaccurate. Okay? And I'm not picking on the advisors, just there's a lack of familiarity there. That's why you need to do yourself a favor, do yourself your own service, and contact us at yourpersonalbank.com. We're just going to educate you. I'll run the numbers for you. I'll talk to you about your situation and see what makes sense for you, run some numbers, and show you the difference and show you how this will work. And again, when people do that, in most cases, they're pleasantly surprised and impressed in many cases, and often end up allocating more dollars than they initially were intending because they recognize of how much benefit this really is. And then in the long term, I'll give you an idea. I've been in the financial world 22 years now plus, and every year we get our updates in terms of retention of clients and things like that. And our 5-year retention rate is well over 98% every time. And this isn't just people are, again, putting money in and leaving it there and just letting it growing or using it or whatever. But in many cases, we have folks that are funding these over years and even decades. So not only are they happy with what the investment, what's happening with the tool, many are adding additional monies to it on a regular basis. You know, you don't add money to something that's not working, right? So, so my point is the proof's in the pudding. The results are there. This has been working for many, many people for decades, with myself personally, and for many, many decades for people across the country. Contact us at yourpersonalbank.com for more information. Be happy to talk to you about it. We can meet online, talk on the phone, whatever, and show you how this can enhance your financial future.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.